Welcome back to the deep dive. Today, we're tackling something really fundamental to understanding any company, their actual conduct.
hmm
We're sort of pushing past the numbers on the balance sheet to look at ethics, their relationships with crucial partners like suppliers, and even, how they engage in the political arena.
That's right. And our source material for this deep dive comes from excerpts of the ESRS G1 standard. This is the European Sustainability Reporting Standard that, well, it zeroes in specifically on business conduct.
Okay, so the mission. Really unpack what G1 requires. Because these standards aren't just for show, right?
Not at all. They're designed so when you're using a company's sustainability report, can get a clear picture of their strategy, their approach, their actual processes, and yeah, how they perform on these core conduct matters.
We want to highlight the most important, maybe even surprising things companies now have to tell us about, well, how they behave.
Okay, let's jump in then. The fundamental objective of ESRS G1, as the standard lays it out, is really to give users the ability to understand an undertaking's approach and performance when it comes to business conduct.
Right.
Think of it as kind of lifting the lid on the how behind the business.
So what specific parts of business conduct does this standard demand transparency on? Because, that phrase can cover a lot of ground.
It structures it into three key pillars.
Yeah.
First, they look at the company's business ethics and overall corporate culture.
Okay.
And this gets quite specific, including things like anti-corruption and anti-bribery efforts, how they protect whistleblowers, and interestingly, it even covers animal welfare.
Wait, animal welfare under business conduct. That feels surprisingly broad for this standard. What's the thinking there?
Well, it signals that the standard setters view a company's ethical footprint as extending beyond just human interactions, to how they treat animals in their operations or supply chain as part of a broader ethical stance, essentially. The second pillar is the management of relationships with suppliers. And a really pointed focus here is on payment practices, specifically preventing late payments, particularly to small and medium-sized undertakings, SMEs.
That specific call-out for SMEs really highlights the practical, sort of real-world impact this reporting aims for, doesn't it?
Exactly. It acknowledges that payment terms can be, well, existential for smaller businesses.
Hmm.
The third pillar, then, is activities related to exerting political influence, including lobbying.
So they have to talk about their ethics internally, how they treat suppliers, and how they engage externally in the political sphere. It covers quite the spectrum.
It really does.
The sources also make it clear this G1 standard isn't a standalone document, right? You don't just read this one piece.
Crucially, no. It's part of a suite. You absolutely need to read it alongside the foundational standards. ESRS 1, which covers the general principles of reporting, and ESRS 2, which sets out general requirements applicable to all topics.
And ESRS 2 links directly to what G1 is asking for.
Absolutely, especially the sections in ESRS 2 on governance, that's GOV, Strategy SBM PAN, and how the company manages impacts, risks, and opportunities, or IROs as they call them.
Right.
For instance, ESRS 2 GOV1 requires companies to disclose the role and, importantly, the specific expertise of their leadership bodies, like the board, when it comes to overseeing business conduct matters.
So who at the top is responsible for ensuring good conduct, and are they actually qualified to do that? That's a key piece of governance transparency.
Precisely. And ESRS 2 IRO 1 requires them to disclose how they even decide which business conduct issues are material or, important enough to report on in the first place. What criteria are they using?
Like a location or sector.
Exactly. Is it based on the location of their operations, the sector they're in, maybe the specific type of transaction? Understanding their process for identifying problems is, well, fundamental.
Yeah, you can't report on what you haven't identified as important. That makes total sense. Okay, let's get into the specifics of what they actually have to reveal, starting with their policies and corporate culture. What does the standard demand here?
Okay, diving into that first pillar.
Yeah.
This is all under what's outlined in the sources around policies and culture, G11. The core idea is that companies must disclose their key business conduct policies and explain how they foster their overall corporate culture.
Okay.
The goal is to show users how these policies help them identify, assess, manage, and fix problems related to material business conduct IROs.
What kind of detail are that they expected to provide about these policies? Is it just like a link to a PDF somewhere?
No, no, it's more than that. They
Mm.
need to describe the actual mechanisms they have, how people can identify, report, and investigate concerns about wrongdoing or behavior that breaks their codes.
Right.
And importantly, they have to state if external stakeholders, like suppliers, customers, community members, can also use these reporting channels.
So transparency on who can blow the whistle, essentially.
Exactly. And here's where the standard gets really pointed. It requires companies to explicitly state if they do not have anti-corruption or anti-bribery policies that align with the UN Convention Against Corruption.
Wow.
And if they lack them, they then have to disclose if they plan to implement them and provide a timetable.
Wow. So admitting a gap in policy is itself a mandatory disclosure.
Yeah.
That's a different level of transparency than just reporting on what you do have.
It forces companies to acknowledge where they might be falling short, doesn't it?
Yeah.
The same applies to whistleblower protection policies. If they don't have them, they must say so and outline their plans and timeline for implementation. And they should reference how they align with relevant laws like the EU Whistleblower Directive.
And how they actually protect them.
Yes, they need to detail how they protect whistleblowers, describing internal channels, how they inform and train workers on using them, training for the staff who actually receive the reports, and the specific measures they take to protect against retaliation, in line with the law.
What about incidents that don't come through a specific whistleblower channel, just general issues?
Good point. They must disclose if they have procedures to investigate business conduct incidents generally, including corruption and bribery, ensuring these investigations are prompt, independent, and objective, even if not initiated by a whistleblower.
Okay.
And circling back to that earlier point, if relevant to their operations, they must disclose their policies regarding animal welfare.
It keeps coming back to that.
It does. Other key policy details required include their approach to business conduct training, who gets trained, how often, how in-depth it is, and identifying which specific functions within the company they've assessed as being most at risk of corruption and bribery.
That makes sense. Target the risk areas. The sources also mention some optional disclosures about how they foster the culture of ethics, not just the policies.
Right. Appendix A suggests companies may choose to discuss aspects of their culture. This could include things like what ethics-related topics the leadership bodies discuss and how frequently, the main themes they're promoting culturally, how leadership provides direction on conduct, or maybe how employee incentives might be linked to fostering an ethical culture.
Okay.
It has a layer of qualitative insight beyond just the formal policies, you see.
Yeah, definitely. Okay, shifting gears slightly, let's look at how they manage those crucial supplier relationships. What does G1 require here? G1 2.
Right, it, G12. This section focuses on how companies manage their relationships with suppliers and the broader impacts within their supply chain. The objective is really transparency about their procurement process and, specifically, how they ensure fair behavior towards suppliers.
And this is where that focus on late payments comes in, isn't it? You mentioned SMEs earlier.
Precisely. A core required disclosure here is their policy specifically to prevent late payments, with particular emphasis on payments to SMEs. This isn't just a general statement. It's about their concrete approach to this specific, often high-impact issue.
Got it. What else do they need to reveal about supplier relationships more broadly?
Well, they must describe their overall approach to managing these relationships. They need to consider the risks the supply chain poses to the company, like disruption, but also the supply chain's impacts on sustainability matters, like labor practices or environmental footprint down the chain.
Two sides of the coin.
Exactly.
Right.
And they also need to state whether and how they incorporate social and environmental criteria when they're selecting suppliers in the first place.
So moving beyond just price and quality, are there other insights they could offer on this, maybe optionally?
Yeah, Appendix A lists several optional points that can really add depth. They may discuss how their supplier practices support their strategy or risk management, for example, how robust relationships help avoid disruptions. They could talk about training or incentives for this procurement staff, noting if incentives are linked to more than just price, perhaps incorporating sustainability factors.
Interesting.
Other options include how they screen supplier performance, their approach to including local or certified suppliers, or how they engage with vulnerable suppliers.
And vulnerable suppliers means?
The standard defines those as suppliers exposed to significant economic, environmental, and/or social risks. So thinking about those who might be disproportionately affected by certain practices.
Yep.
They could also report on targets for communication with suppliers or how they evaluate outcomes, perhaps through audits or surveys. Lots of potential detail there.
That really paints a picture of how integrated or not sustainability thinking is in their core purchasing decisions. Moving on, let's talk about the specific system for combating corruption and bribery. That's G1-3.
Correct, G13. This section requires companies to detail the procedures they have in place to prevent, detect, investigate, and respond to any allegations or confirmed incidents of corruption and bribery. It also covers the training associated with this system.
And the objective.
Simple transparency, really. Provide transparency on these critical anti-corruption measures.
What specific procedures do they have to describe? Is it just a high-level overview?
No, it's fairly detailed. They must describe their core prevention, detection, and response procedures. And a key piece of transparency here is stating whether the individuals or committees responsible for investigations are independent. Meaning they are separate from the management chain that might actually be involved in the issue being investigated.
Oh.
Ensures objectivity.
Makes sense.
They also need to describe their process for reporting the outcomes of these investigations up the chain to the administrative, management, and supervisory bodies, basically, board oversight.
And again, the state, if you don't have it rule, applies here too, like with the policies.
Exactly. If they lack these procedures, they must disclose that fact and outline any plans to adopt them. They also have to explain how they make these policies and procedures known to everyone who needs to see them.
Not just employees.
Right. Employees, contractors, suppliers, value chain workers, even investors. Appendix A suggests mentioning communication tools and efforts to remove barriers, like using translations or clear graphics. Accessibility is key.
Yeah, communication is vital if these policies are going to be effective in practice. What about the training component?
Required disclosures here include the nature, scope, and depth of their anti-corruption and anti-bribery training programs. They also have to report the percentage of their functions at risk that are covered by this training.
And functions at risk means what exactly?
The standard defines these as the roles or tasks within the company deemed to be at a higher risk of encountering or being involved in corruption or bribery based on their responsibilities.
So it's about targeted training.
Exactly. It emphasizes targeted training where it's most needed. They must also disclose the extent to which their leadership bodies, board members, top executives receive this training. Appendix A also mentions that they may optionally provide analysis of this training by region or worker category for added detail.
Okay, switching from policies and procedures to the actual numbers, the metrics. What do they have to report if corruption or bribery incidents do occur? G14.
Yes, G14 focuses on incidents during the reporting period. The objective here is direct transparency on what happened and, well, the consequences.
What specific metrics must they disclose? What's the bare minimum?
They are required to disclose the number of convictions against the company and the total amount of fines levied for violating anti-corruption or anti-bribery laws.
Okay, convictions and fines.
And they also have to report on any actions taken to address breaches of their own internal procedures or standards that were uncovered during investigations.
And what can they report beyond that mandatory stuff? Optional metrics.
They may provide the total number and nature of confirmed incidents. They could report how many of their own workers were dismissed or disciplined as a result, and how many contracts with business partners were terminated or not renewed due to violations.
That gives more context.
Definitely. They can also provide details on public legal cases related to corruption or bribery brought against the company or its workers during the period, including their outcomes.
Now, does this cover incidents anywhere in their supply chain, even if their own staff weren't directly involved? How far does it reach?
That's an important point. The standard is specific on this. These disclosures include incidents involving actors in its value chain only where the company itself or its employees were directly involved.
Oh, okay.
It's focused on the undertaking's direct implication, not necessarily systemic issues across the entire value chain unless they were a party to it.
That scope is important to understand. Okay, let's move to the next metric section, G15, and this one sounds particularly intriguing. Political influence and lobbying.
It is indeed. G15 requires information on activities and commitments related to exerting political influence. This specifically includes lobbying that's linked to their material impacts, risks, and opportunities, their IROs.
And the objective, more transparency.
Transparency, yes, about these activities and also the purpose behind them. Why are they lobbying on certain issues?
What are the mandatory disclosures here? What do they have to tell us?
Well, if applicable, they must identify which representative or group within their leadership bodies, their board or management, is responsible for overseeing these political influence activities.
So who's the top person accountable for lobbying oversight? Got it.
Exactly. Then, for any financial or in-kind political contributions they make,
In kind meaning.
like non-monetary support, maybe loaning staff, providing facilities, that kind of thing, Appendix A defines both direct and indirect contributions. For those contributions, they have to disclose the total monetary value. This needs to be aggregated by country or geographical area and by the type of recipient, like a political party, a candidate, or maybe a think tank. And if they make those non-monetary in-kind contributions, they must explain how they estimated the value.
Right. And what are they actually lobbying on? Do they have to spell that out?
Yes, and this is a really significant requirement. They must disclose the main topics their lobbying activities cover and their main positions on those topics.
Okay.
And, crucially, they need to explain how this lobbying interacts with the material impacts, risks, and opportunities they've identified and reported elsewhere.
Ah, so that links their public lobbying efforts directly back to the sustainability issues they've deemed most important. That's a powerful connection.
It forces companies to show how their actions align, or perhaps don't align, with their stated priorities. They also have to state if they are registered in the EU or a member state transparency register and provide their ID number if they have one.
There was also that specific, quite surprising requirement in the sources about people joining their board, wasn't there? Something about former public officials.
Yes, this is a really specific and quite insightful requirement. It seems designed to capture potential influence dynamics. The company must disclose information about the appointment of any members to their administrative, management, or supervisory bodies who held a comparable position in public administration.
Including regulators.
Including regulators, yes, in the 2 years before joining the company's board, if that appointment happened during the current reporting period.
Wow.
Appendix A gives guidance on what comparable position means, looking at the level of responsibility and scope in their previous public role.
So bringing former regulators or senior public officials onto the board has to be disclosed. That seems designed to make potential revolving door scenarios transparent.
That's certainly the implication, shining a light on appointments that could involve prior relationships or expertise gained from a public position relevant to the company's activities.
Interesting. Are there optional disclosures here too?
Yes, Appendix A mentions optional disclosures for lobbying, like reporting total internal and external lobbying expenses or membership fees paid to lobbying associations. And importantly, Appendix A reinforces that companies, when reporting on lobbying topics and positions, should consider the alignment between their public statements on their material IROs and their actual lobbying activities.
Right.
It's not a mandatory metric to report non-alignment, but it's a strong suggestion embedded in the guidance, basically. Check yourself.
That consider alignment point is key. It's asking them to reflect on potential contradictions between what they say publicly about sustainability and what they lobby for privately. Okay, finally, let's look at G16, payment practices. Back to the suppliers.
Yes, this gets right back to that concrete high-impact area we mentioned earlier. It requires companies to provide information on their payment practices with a specific focus on late payments to SMEs.
And the objective.
To give users insights into their contractual payment terms and, critically, their actual performance against those terms, especially concerning SMEs who rely on timely payments.
What specific numbers do they have to report on payment practices? What's the key metric?
They must disclose their average time it takes to pay an invoice, stated in days.
Simple, clear, and very relevant for a supplier waiting to get paid.
Exactly. Very direct. They also have to provide a description of their standard payment terms, also in days, broken down by the main categories of their suppliers, maybe wholesalers who are different from service providers, etc.
Okay.
And alongside this, they must disclose the percentage of their payments that were actually made in alignment with those standard terms. Appendix A notes that standard terms can vary by country or supplier type, and companies should provide this context.
The source materials even gave that helpful ABC example to show how this might look in practice, didn't they?
They did. That example from Appendix A is quite good. It shows a company, ABC, reporting different standard terms. Maybe payment on receipt for wholesalers, 30 days for services, 60 days for others generally, but maybe 90 days in country X for specific reasons.
Right.
They then show the percentage of invoices covered by each term category, and presumably, though it wasn't explicit in that snippet, they'd report how well they adhere to those terms for each category. It makes it very tangible.
Are there any other mandatory disclosures here for payment practices?
Yes, one more key one. They must report the number of currently outstanding legal proceedings they're involved in, specifically related to late payments.
Ah, okay. Legal challenges.
Right. And finally, they need to provide any other complementary information necessary for users to understand the data. Like if they used a sampling methodology to calculate the average payment time, they need to explain how they applied it.
So bringing all these pieces together then, from culture and whistleblowers, supplier payments, lobbying, what does the picture painted by ESRS G1 reporting really offer us, the users of these reports?
Well, collectively, these disclosures move beyond abstract statements or vague commitments. They provide a structured, detailed, and increasingly standardized view of a company's ethical foundation, how it manages crucial operational relationships, like those with its suppliers, and how it seeks to influence the external environment, including politics.
And for you, the listener, the learner, why is all this granularity so valuable? Why should you care about these specific disclosures?
Because it gives you a tangible framework to look beyond the financial headlines or, the glossy marketing materials. It offers crucial context for evaluating a company's true sustainability, its operational integrity, and its corporate responsibility.
So it's about getting real evidence.
Exactly. It points to specific policies, procedures, and even metrics you can look for to understand how a company actually operates on key conduct issues, rather than just what it says it believes or aspires to.
It feels like standards like this are really pushing companies into revealing information that was previously hidden, maybe, or just not considered relevant for public reporting.
Absolutely. They are demanding transparency in areas critical to a company's real-world impact and ethical standing, providing stakeholders, investors, employees, customers, everyone with vital insights.
So we've taken a pretty deep dive into the specifics of ESRS G1 business conduct reporting, covering everything from the expected policies around ethics and whistleblowers, through the management of supplier relationships, the fight against corruption, and that often opaque world of political influence and lobbying, right down to the nitty-gritty of payment practices.
It's definitely a comprehensive look at how sustainability reporting is maturing, requiring detailed disclosures on these really fundamental aspects of corporate behavior.
So here's a final thought for you to consider as you mull over these requirements. Knowing that companies now have to report on topics like their policies to prevent late payments to SMEs or disclose former regulators sitting on their board, and are actively encouraged to consider the alignment between their public sustainability commitments and their actual lobbying efforts. How might this big push for transparency fundamentally change corporate behavior and maybe shape public trust in the long run? Something to chew on.